Well, it's time for another Rogers Capital Market commentary where we attempt to be the antidote to water cooler wisdom. What's going on around the water cooler these days? What are you seeing on TV, on your phone? Tariffs, right? So I'm going to get to that momentarily. Through yesterday, March 3rd, the S&P was down a half point. The market was down a half point for the year. 2 weeks ago, we were at all-time highs. 2 weeks. And now we've got ourselves in pullback territory, down a little over 5%. Fourth quarter earnings season is nearly over, and it was a good one. In the fourth quarter, America's corporations had strong corporate profits. In fact, the S&P company's up 8% year over year. But the road gets tougher from here. Tariffs mounting, evidence the economy is slowing. Achieving a double-digit earnings growth this year for the S&P is going to be a tall task. Inflation, good news, decelerated as consumer demand softened in January. Real spending fell 0.5% after a robust Christmas season. Savings rate, though, has jumped up to 4.6%, suggesting that consumers, Americans, are positioning for some slowdown, tempering their views on the strength of the economy. So we seem positioned for a slowdown, not a crash, a slowdown. And could be more pronounced in the second quarter and the third quarter, dependent upon the magnitude and the duration of these tariffs. But yes, tariffs. If you've had your phone or your in front of you or your TV on, it's all you've heard about here recently. It's not the first time we've had tariffs. Some of you may remember that in 2018, first time Trump was in office, he slapped tariffs on the Chinese. In fact, it was really a little tit for tat situation in 2018, trade or tariff war, and market was down about 20% during that. But inflation was zero, nil. In 2022, I would guess none of you know this, that President Biden added to those tariffs on the Chinese. I bet you haven't heard that. And I bet you haven't heard that they're all still in place. Now, what happened last time with the tariffs? Again, inflation was close to zero. What we saw, though, was business go to other places. Manufacturing go to Indonesia, Mexico, the Pacific Rim, Vietnam. We saw folks adapt. In fact, China was almost 25% of our imports, and today they're like 12, I think they're 12%. So a substantial drop. What happened? Business went elsewhere. Now, yes, a little different this time. In fact, roughly 40% of all goods imported into this country come through Mexico, Canada, China, or from Mexico, China, Canada. So potential impacts to the broader economy of slapping, large tariffs on these three are a little bit of a, difference maker. And it's really going to depend on the flexibility of American companies to find alternative supplies and manufacturing, and exceptions to the tariffs as well. That's not the only thing we've got going on. Several other undercurrents. Yes, even pushing and pulling stocks in both directions, up and down. The headwinds, again, tariffs, those trade tensions. Also, just evidence of this slowing growth. AI scrutiny with the DeepSeek Chinese thing several weeks ago. the market rotation from U.S. to a little bit of a trend towards internationals. Low correlations, intra-market correlations, weak breadth on the market, technical resistance. We talked about this last time. It's not easy to continue to put 20%ers on the board like we have the last 2 years. Tailwinds, however, things pushing us higher. Steady demand for momentum stocks, retail dip buying in this little pullback, likely Fed rate cuts, in fact, especially with maybe some slower economic growth and consumer savings rate higher, more cuts or quicker cuts. The AI productivity narrative is really has been preserved throughout this earnings season. So several tailwinds, several positives as well. With earnings growing steadily, with the odds of recession still very low, Treasury yields edging lower, tax cuts on the way, I continue to favor the take opportunities when we can by the dip versus massive, downshifting, de-risking to 50, 30 miles per hour. Okay. But, you're all different. Happy to discuss where you're at, what diversification level we should be at with this volatility for 2025. Okay. What's not different for all of us is that volatility happens. You'll remember me saying 4, 1, and 1 and 4. 4 times per year we see this that you're seeing on the news right now, a 5% pullback. Yes, they happen. They happen 4 times per year, once a quarter. We see once a year a 10% correction, which we haven't gotten to yet, but 10% corrections, they happen. In fact, they happen once a year. And then once every 4 to 5 years, we have a bear market, a 20% plus correction. So again, volatility comes with the territory. 4, 1, 1 and 4. So tariffs. There's more going on than just tariffs. That's it for this month. Happy to talk with anybody. You know how to get a hold of us. We'll see you next time.